Everybody's talking, can this rally continue? And I try and remind people that this is a bull market. Yes, we're going to have rallies. We've already had, 15 downturns since 2010 that were 5 to 10%, and 6 that were between 10 and 20%. And the market snapped back very quickly. So when I look at what Restoration Hardware is doing, they're just playing outside the box, because the brick and mortar stores weren't going to work. But what they're trying to do, and what they've succeeded in doing so far, is developing a business plan outside of the box and the norm.
All right. So, Jim, while we try to weigh the impact of tariffs, there's the low interest rate environment to consider. Right. And I know they're related, but is there a sense that if bond yields are ridiculously low globally, that means the flip side of the coin is that stocks are ridiculously high, or do you think, are you comfortable with what we're seeing here?
Well, I think it's a question of valuation. So what low interest rates do is it increases valuations. So if we think about the cash flow of all these companies or bonds in general, you end up discounting those cash flows at a lower interest rate, which increases the present value. So that's all the technical jargon to say that's why prices are up so high right now, because rates are so low. Sure. Now, the issue, though, is that these are insurance rate cuts that the Fed is talking about, which means that these rate cuts are designed to stave off a recession. So not only are rates low, but they're also telling you that we're going to reduce the probability of a recession going forward, which means default risk in corporate bonds goes down. Bond prices go up.
If they really believe we're reducing the recession risk, shouldn't rates go back up? I mean, at some point, it doesn't make sense.
So we're in this sort of sweet period right now, right? In the sense that rates are coming down, recession risk is coming down as well. That's boosting asset prices up higher, whether it's equity. But think about it, equity prices are high, but our earnings also going up as well? Maybe not.
So what do you think evaluations overall here are?
So I think, I think we have to put it into context, right? So if we believe that a 2% 10-year note is about the fair level, and maybe it goes a little bit lower, maybe it drifts a little bit higher, then valuations around these multiples might seem about right. Now, in the future, it could be different. You're probably around like the 17, mark. I would say at about a 2% 10-year note, that's about right. But in order to get a lot higher than that, then rates have to go down further, but for good reasons. If they start going down for the wrong reasons, that's when we start having to worry about default risk and asset prices coming down.